A few weeks back, on a Sunday evening, I found myself mindlessly browsing YouTube in search of something to watch when I unexpectedly came across some surprising news. Consumer prices had persistently deflated for the third consecutive month on a yearly basis, marking the slowest pace since 2009. Concurrently, a mounting debt crisis was gripping the economy, prompting investors to call for fiscal stimulus to spur growth. This left me puzzled, especially after reading about China's impressive 5.2% economic growth in 2023 just the day before. Intrigued, I delved deeper into the issue, intending to scratch the surface. However, as I continued my research, I unearthed revelations that completely reshaped my understanding of China's economic landscape. China is currently grappling with a looming debt crisis and a concerning period of deflation that threatens to halt its 45-year streak of economic growth and reform. This predicament is not rooted in a single cause, but rather stems from a complex interplay of policy decisions, unforeseen disease outbreaks, market euphoria, misinformation, and errors. What began as a mere curiosity evolved into an extensive research endeavor, leading me to compile perhaps the most comprehensive insights I've ever gathered for a video. Join me as I navigate through the fissures emerging across every sector of China's economy, painting a somber outlook for a nation that has witnessed 4.5 decades of continual growth. China currently stands as the world's second-largest economy, a status it didn't always hold. Founded in 1949 by the Marxist dictator Mao Zedong, the country initially adopted economic principles mirroring those of the Soviet Union, with no room for private property or market dynamics. Skilled workers were assigned jobs, and their wages were determined not by market forces but by governmental decree. This flawed economic framework was exacerbated by China's severe impoverishment in the 1950s, culminating in a devastating famine from 1959 to 1961 that claimed the lives of an estimated 30 million individuals. Upon Mao's death in 1976, Deng Xiaoping assumed leadership, kickstarting a transformative economic era through sweeping reforms. These reforms birthed the longest and most prosperous period of economic expansion in human history. Deng initiated the establishment of special economic zones like Shenzhen, which would later emerge as a global economic powerhouse, fostering trade, technology, and financial prowess. Transitioning from leadership, Deng handpicked successors, notably Jiang Zemin, who steered China towards further economic progress from 1989 to 2002. Under Jiang's rule, China continued its economic ascent, witnessing accelerated GDP growth that propelled the nominal figure to $1.2 trillion by 2000, with real GDP expanding at near double-digit rates. Following the succession lineage in 2003, Deng's designated successor assumed leadership of China. His name was Hu Jintao, ushering in another decade of remarkable growth. By 2011, his final year in office, China surpassed Japan to become the world's second-largest economy, boasting a GDP of $7.5 trillion. In 2012, Xi Jinping assumed control of China, initially viewed as a proponent of market reforms aiming to enhance the role of free markets in resource allocation. By 2015, the World Bank noted China's significant progress, with the percentage of the population living in poverty dwindling from 88% in 1981 to a mere 7%. Nearly 1 billion individuals were lifted out of extreme poverty within just 35 years, a feat of staggering proportions. Despite these strides, China remains deeply rooted in communism. However, in 2017, China began retracting some reforms, reinstating state control over markets. Notably, state-owned enterprises, SOEs, hold a pivotal position in China's economy. In 2017, the National University of Singapore reported that China boasted the largest number of SOEs globally. By 2019, over 60% of China's market capitalization derived from state-owned entities, with 40% of the $14.9 trillion GDP in 2020 attributed to them. The significance of these enterprises in China's economic challenges will be further explored in this video. One such company under scrutiny is Evergrande, China's second-largest property developer, teetering on the edge of collapse. The turmoil extends to China's stock markets, witnessing a staggering $6 trillion decline in the value of Chinese and Hong Kong stocks in recent years. China has been grappling with a series of crises, ranging from the disruption of the job market due to stringent COVID-19 policies to the catastrophic crash of the real estate sector, with trillions wiped off public companies' valuations. These crises are not random occurrences, but rather the repercussions of pivotal policy decisions, market speculation, and greed. they portray an economy on the brink of the world's most substantial debt crisis, with looming prospects of stagnation in the years ahead. The COVID-19 pandemic inflicted severe blows on China's economy in 2020, with GDP growth plummeting from 6% in 2019 to a mere 2.2%. This decline stemmed from hindered consumer demand, reduced production, and a slump in private business investment. Despite these challenges, China managed to maintain growth, contrasting with the US, which witnessed a negative GDP growth of -2.8%. The resilience can be attributed to China's strategic increase in investments, predominantly driven by state-owned enterprises, offsetting the dip in personal consumption, albeit fueled by substantial debt. The discussion about China's prevailing debt crisis and the concealment of economic issues becomes particularly salient. In 2021, China witnessed a resurgence in GDP growth, soaring to 8.4%. However, the 2022 resurgence of COVID-19 prompted Xi Jinping to enact the rigorous zero-COVID policy, precipitating a sharp decline in economic growth to 3%. This policy, heavily reliant on increased investment spending, inflicted lasting harm on numerous Chinese provinces. Subsequently, a multitude of foreign companies shuttered their operations in China, leading to widespread layoffs. In 2020, a staggering 63,000 foreign-invested enterprises departed China, followed by 61,000 exits in 2021 amidst growing concerns. It became evident that COVID-19 was merely a fraction of China's mounting troubles, as the country stood on the brink of grappling with an unprecedented real estate collapse. The genesis of this crisis dates back to the mid-90s, when China's economic reforms elevated millions from poverty to the middle class, fueling a surge in demand for mid-range housing. Innovatively, in 1994, China introduced a novel model for property developers, enabling the sale of apartments before completion, or in some cases, before project initiation. Noteworthy among these developers was Evergrande, established in 1996. Evergrande's strategy involved borrowing from lenders, receiving prepayments from customers, constructing properties, selling them, and utilizing returns to offset debts. By 2021, Evergrande boasted 1,300 projects across 208 Chinese cities, amassing property revenue of $76 billion, securing its position as China's second-largest property developer. Despite this success, mounting debts plagued the company, culminating in liabilities to Chinese banks and foreign investors amounting to $35 billion by the same year. The property market in China had metamorphosed into a speculative bubble, with escalating home and apartment prices enticing speculation. In response, Xi Jinping imposed stringent regulations in 2021, restraining developers from rolling over debts, necessitating asset sales or cash settlement. Evergrande's financial woes surfaced in late 2021 with missed debt payments, leading to a default declaration by S&P Global on December 17th. Despite asset liquidation efforts in 2022, Evergrande succumbed to bankruptcy on August 17, 2023, epitomizing the broader turmoil engulfing China's property market. Since 2021, a staggering 53 developers have collapsed, with 34 of the top 50 non-state-owned developers facing insolvency. The default rate for Chinese real estate US dollar bonds now exceeds 50%, underlining the severity and persistence of the crisis. Beyond the property sector, China's economic tribulations extend further. As reported by Fortune, a colossal $6.3 trillion in value has been obliterated, signaling the multifaceted challenges facing the nation. These challenges underscore the intricate economic landscape in China, characterized by debt burdens, speculative bubbles, regulatory interventions, and the repercussions of a real estate market in turmoil. Resolving these issues is imperative for China's economic stability and future growth prospects. Recent trends in Chinese and Hong Kong stock markets, coupled with Tokyo's surpassing of Shanghai as Asia's largest equity market, have sparked concerns. Factors such as tumult in the real estate sector and escalating political tensions between the US and China are driving investor withdrawals from equity markets. However, a deeper examination reveals a more nuanced narrative.